The crypto market just crashed. Here's what happens next. Over $200 billion just vanished from the crypto market in hours. Bitcoin crashed, altcoins tanked, and panic is spreading fast. But is this the beginning of the end or the biggest opportunity of the decade? Let's break down exactly what happened and what comes next. The crypto market just went into freefall, billions wiped out in a matter of hours. Charts are bleeding red, fear is spreading across exchanges, and investors everywhere are asking the same question: what happens next? Today, we're breaking down exactly why this crash happened, what it means for Bitcoin, Ethereum, and altcoins, and most importantly, how it could shape the future of the entire crypto space. The crypto market just experienced one of the biggest shakeups we've seen in months, and traders, investors, and even casual holders are all asking the same question: what happens next? The sudden dump has rattled portfolios, shaken investor confidence, and sparked waves of speculation across the globe. But before we panic, let's break down what actually happened, why it happened, and what it could mean for the short-term and long-term future of digital assets. If you woke up today and saw red candles everywhere on your charts, you're not alone. Billions of dollars in market capitalization were wiped out in just hours. Bitcoin, the king of crypto, dropped sharply, dragging Ethereum, altcoins, and even stablecoin liquidity pools into the turbulence. This wasn't just a minor pullback, this was a widespread sell-off that reminded investors that crypto is one of the most volatile markets on the planet. Now, crashes don't come out of nowhere. There are always catalysts, both visible and hidden, that cause these sudden moves. In this case, a combination of factors aligned like dominoes. First, global economic uncertainty. Inflation reports came in hotter than expected in the United States, sparking fears that interest rates may stay higher for longer. When that happens, risk assets like crypto are usually the first to take a hit. Big institutional players often move out of volatile markets and into safer assets like bonds, cash, or even gold. At the same time, regulatory pressure has been mounting. Governments across the world have been tightening their stance on exchanges, stablecoins, and even DeFi projects. Recently, rumors and reports of fresh crackdowns in multiple countries fueled the fear. Traders hate uncertainty, and in crypto, regulatory uncertainty almost always triggers panic selling. Add to that a few high-profile exchange wallet movements and whispers of possible liquidations, and suddenly everyone wants to hit the sell button at once. Of course, it doesn't help that crypto is heavily leveraged. Many traders borrow money to amplify their bets, hoping for outsized gains. But leverage is a double-edged sword. When prices fall, leveraged positions get liquidated automatically, adding more downward pressure. This creates what's known as a cascading liquidation event, where one sell-off triggers another, and another, until the market free falls. That's exactly what we witnessed. Billions of dollars in leveraged longs were wiped out in a matter of minutes, fueling the bloodbath. Now, here's the key question everyone wants answered: is this the end of the bull cycle, or is it just a temporary dip? To answer that, we need to zoom out and look at the bigger picture. Historically, Bitcoin and the broader crypto market have always gone through extreme volatility. Huge pumps are followed by massive corrections. That's the rhythm of this market. For example, in 2017 Bitcoin soared to nearly $20,000, then crashed down by more than 80%. Yet years later it not only recovered but smashed through previous highs. In 2021, we saw a similar cycle play out. So, if history tells us anything, it's that these crashes are not unusual, they are part of the game. However, the difference today is that the market has matured significantly compared to earlier years. We now have institutional investors, ETFs, major corporations holding crypto on their balance sheets, and governments exploring central bank digital currencies. The crypto space isn't just a playground for retail traders anymore. That means while volatility is still extreme, the underlying foundation is stronger. Corrections may be violent, but the long-term trajectory is still upward as adoption continues to grow. But let's not sugarcoat it. In the short term, things may remain painful. When markets crash, confidence takes time to rebuild. Some retail investors panic sell at a loss, while whales and institutions quietly accumulate at discount prices. That's the brutal reality. Weak hands exit, strong hands enter. And those who hold through the storm often come out stronger on the other side. So, what should we expect in the coming weeks? First, more volatility. Don't be surprised if Bitcoin and Ethereum bounce up and down like a roller coaster. Markets rarely recover in a straight line. Instead, they consolidate, test support levels, and slowly build momentum. For Bitcoin, key support zones to watch are around the previous consolidation ranges. If those hold, we may see a steady recovery. If they break, another leg down could be on the horizon. Altcoins, on the other hand, often suffer harder than Bitcoin in these situations. When panic sets in, liquidity flows out of altcoins first. Projects with weaker fundamentals may never recover. That's why in times like this, investors often rotate back into Bitcoin or stablecoins, waiting for clearer signals before re-entering the riskier parts of the market. Now, let's talk psychology, because this part is just as important as charts and numbers. Crashes test emotions. Fear and greed are amplified in crypto like nowhere else. During bull runs, everyone feels like a genius, and during crashes, everyone feels doomed. But the truth is, neither extreme is permanent. Smart investors know that cycles repeat, and every crash also plants the seeds of the next rally. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." While crypto is far riskier than traditional markets, the principle still applies. Another aspect to consider is innovation. Even while prices tumble, development in blockchain technology continues at full speed. Layer 2 scaling solutions are expanding, decentralized finance is evolving, NFTs and gaming are building new ecosystems, and real-world asset tokenization is becoming a hot topic. In other words, the builders aren't leaving. Every crash wipes out speculation but leaves behind genuine innovation, and that innovation is what fuels the next wave of growth. So, what does this mean for investors right now? Number 1, don't make decisions purely on emotion. Panic selling at the bottom has destroyed more portfolios than holding through corrections. Number 2, focus on fundamentals. Which projects are actually delivering real value, solving real problems, and building strong communities? Those are the ones most likely to recover and thrive long term. Number 3, risk management. Never invest money you can't afford to lose, and always diversify. Crypto should be a part of a broader portfolio, not the entire portfolio. Let's also address the possibility that this crash is not just about crypto but about global finance in general. We are living in uncertain times. Interest rates, inflation, geopolitical conflicts, supply chain disruptions, all these factors weigh heavily on global markets. When traditional markets wobble, crypto usually reacts with even more intensity. That's why it's important to keep an eye not just on Bitcoin charts but also on stock indices, commodity markets, and central bank policies. Crypto doesn't exist in isolation, it's tied into the broader financial world. Interestingly, while crashes bring fear, they also bring opportunity. Historically, some of the best investment returns come from buying during times of maximum fear. Of course, timing the bottom is nearly impossible, but dollar-cost averaging buying small amounts over time regardless of price has been a successful strategy for many investors. It reduces the emotional stress of trying to catch the perfect entry point and allows you to benefit from long-term growth. In the end, whether this crash turns out to be just a temporary dip or the start of a deeper bear trend will depend on multiple factors. How quickly can the market absorb the liquidations? Will regulatory news improve or worsen? Will institutional demand return? And perhaps most importantly, will retail investors regain confidence? These are questions we'll only get answers to in the weeks and months ahead. But here's the perspective I want you to take away. Crypto has been declared dead dozens, if not hundreds of times, over the past decade. Each time, it has bounced back stronger. From Mt. Gox collapses to China bans, from SEC lawsuits to exchange bankruptcies, this market has survived everything thrown at it. And every single time, new all-time highs eventually followed. That doesn't mean it's guaranteed, but it does mean resilience is built into the DNA of this industry. Yes, the crash is real, and yes, it hurts, but history shows us that every dip in crypto also plants the seeds for the next massive rally. What happens next isn't just about prices, it's about innovation, resilience, and the people who refuse to give up on this technology. Stay calm, stay focused, and remember, today's fear often becomes tomorrow's opportunity. Thanks for watching. If you found value in this breakdown, don't forget to like, share, and subscribe for more updates as we track the next big move in crypto.